Say you want to get rich. And in this economy, I get that, it's completely understandable. But there's a slight problem. And that's the fact that you don't know how to get rich. But don't worry, this is exactly why I'll be sharing 6 life-changing lessons about money that are going to change the game for you forever. Not only that, but once you watch this video, you'll already know more about money than most people out there. So let's get started. Hello and welcome back to Tied to Wealth, where you are just one sale away from reaching financial success. Alright, so the first thing, let's talk about the elephant in the room, that theory isn't reality. And before I tell you what that means, I'll share a quote from Housel's book, The Psychology of Money. The challenge for us is that no amount of studying or open-mindedness can genuinely recreate the power of fear and uncertainty. Here's the thing, folks. The problem is, people start thinking that just cause they read all the books, tracked all the stocks, and took the online lessons in the world, they can predict what's going to happen. But sadly, that's not how the world works. Learning about stock market crashes or rises is very different from experiencing it in reality. For example, right now, you might be thinking only suckers sell low and buy high. But when it's your own money on the line, even a 10% market downturn might make you shaky, leading to a portfolio sell-off at a loss. When you experience a downturn in real life, that's when you're actually going to find out what you're made of, and what you'll do in situations like this. The point is, unless you're investing in the market yourself, reading about it won't do much for you. So, it's important to differentiate between theory and reality, and it's important to experience certain things for yourself. Well, with that out of the way, let's talk about another lesson that will change your life, and it's all about the tussle between luck and risk. It's easy to believe that your good financial outcome happened all because of your decision and work, but, newsflash, that's not true. You can make perfectly fine decisions, and they can still lead to a poor outcome. Or you can make a horrible decision, but by a stroke of luck, you can end up with a good outcome. So whenever you're hedging your portfolio, whenever you're putting your hard-earned money into stock, what you've got to account for is the role of luck and risk. First of all, be careful about who you follow and who you try to avoid being like. Someone at the top might likely be benefiting from some great luck, and it's also likely that those at the bottom may have just had horrible luck. So, what do you need to do? You need to focus less on people and more on patterns. That's the 2 Ps. While it might be difficult to replicate the success of people like Warren Buffett, you can still participate in broader patterns. For example, instead of just buying and selling exactly like Berkshire Hathaway, you can also just try to invest in stock you think is valuable and hold it. Here's what the psychology of money says about the role of luck. But more important is that as much as we recognise the role of luck in success, the role of risk means we should forgive ourselves and leave room for understanding when judging failures. Wait, this seems like generic advice. So why is this life-changing again? I'll tell you why. It's because this teaches you to be kind to yourself if and when you make a mistake. We live in a super uncertain world, so it's not entirely your fault if something doesn't go the right way. Here's what Warren Buffett says about the entire thing. There's no reason to risk what you have and need for what you don't have and don't need. And that's exactly the point. When it comes to money, there's always going to be someone who has more than you, which is okay. There's nothing wrong in trying to make more money, of course, but don't make risky bets or don't risk everything to get what you don't need. So if your buddy tells you to put all your money in the stocks of a company that's just about to blow up, the smarter bet would be to not listen to them. And look, if you think that that stock really is going to blow up, there's no harm in investing a bit of what you have. But everything? Nah. By the way, if you're enjoying everything in this video so far, would appreciate it if you could just like and subscribe. Alright, time for your next lesson. Hammer this into your head, folks, because getting money and keeping money are 2 very different things. You see, to get money, you need to put yourself out there. You need to take risks, and you need to do things that no one's ever done before. But keeping money is exactly the opposite. To keep money, you've got to be low-key and you've got to be humble. You've got to have the fear that it can all be taken away at some point. You have to be frugal, and you have to let yourself know that maybe you just made all this cash because of luck. So it's going to be difficult to repeat your success forever and ever. So, if you want to get money, take risks and be optimistic. If you want to keep money, avoid risk and try to put it all in safe investments. Which brings us to the next lesson. Cash is not the enemy. Yes, I know. If you keep your money in cash, you're losing it to inflation. I get it. However, when people tell you to barely keep any cash, they don't really account for your psychology. Let's imagine a little scenario. Let's say you got 95% of your money invested into stocks and you got 5% of it in cash. All of a sudden, the market declines 25%. Chances are the crash is really going to mess you up, and having such a small percentage of your portfolio in cash might make you panic sell your stock. Then that panic sell will lead you to miss out on the massive returns you could have made. And this isn't even a made up scenario. This actually happened in March 2020, when the author of The Psychology of Money was too invested in the market and didn't have as much cash. He sold some of his portfolio. Now we know just how costly that was, since the market reversed super quick and the stock prices went through the roof. So yes, on paper you can maximise returns by being only 1 to 5% in cash. But when you factor in human psychology, it's better to hold 10 to 20% in cash to protect yourself from panic selling. So in the long run, this might actually be what's the most beneficial for you. Now, I know what you're thinking. Why are we talking about investing and portfolios anyway? To get rich? Nope. It's to get wealthy. But wait. Is there a difference? Yep, there is. And it's pretty big. You have a high income. Congratulations, you're rich. But you're still not wealthy. While being rich is visible, being wealthy isn't. Wealthy is the money that you have that is not spent. It's the option to buy or do something in the future. While being rich means you've got opportunities in the short term, being wealthy allows you to dictate your future, your working hours, and even how your future generations will live. Housel said this in the book. The ability to do what you want, when you want, with who you want, and as long as you want, is priceless. It is the highest dividend money pays. This is powerful. Having flexibility over your time is more valuable than anything. So instead of trying to impress other people with cars, watches, and mansions, be wealthy and live life by your own rules. And to be wealthy, you need to have an optimal portfolio. Now, again, this isn't any professional financial advice, but remember the 2 P's I talked about: patterns and people. Well, this is exactly what those numbers say, because an optimal portfolio allows you to sleep well at night. It generates reasonable returns. However, it's also not too risky. It's a portfolio that has stood the test of time and that has gone through recessions. But to create such a portfolio, you need to know one thing, and that's the fact that you need to leave room for error. According to The Psychology of Money, room for error lets you endure a range of potential outcomes, and endurance lets you stick around long enough to let the odds of benefiting from a low probability outcome fall in your favour. There is no way you're going to follow everything by the book. If you've got several years of savings and you want to quit your job to work on a business, you might not get the results till you've got only 10% of your original money left with you. However, you might be compelled to give up and go back to work as soon as your savings hit 40 to 50%. It's because you didn't leave room for error. You believe that you'll be making money in a couple of months and you'll be successful for the rest of your life. But what if that doesn't happen? What if you make mistakes? And then, just when you're about to make it big, you quit everything and go back to work. At the same time though, this wouldn't entirely be your fault. Because the next lesson you need to understand is that long-term financial planning is extremely difficult. As humans, we tend to change a lot over time. At first, we may not want kids, might not want a big house or a nice SUV, so we don't plan for it when we're young. Well, all of that can change quite quickly, and all of a sudden, it feels like you don't want these things, you need them. So instead of making a specific plan and then getting upset when you can't stick to it, it's better to just aim for general wealth. To be wealthy, to be successful, don't make objects, for example, a Ferrari, your goals, but instead, make your well-being the main goal. And this is exactly what the last life-changing lesson that I'm going to talk about is, why you shouldn't just blindly follow others. Let's say you got a friend who's super duper successful thanks to trading short-term options. You start playing that game too to replicate their success. Well, if your goal is to have money 20 years down the line and you're the kind of person who's anxious about their investments, then the best thing for you would be to stay as far away from your friend's game as you can. Instead of trying to replicate your friend's success, it's better to account for what you want and the kind of person that you are. Well folks, that's all for today. Let us know what your favourite life-changing lesson about money was in the comments below. Thanks for watching. Until next time.